Welcome to the Ellsworth Advisors monthly update for the month of July. I'm Kelly Keenan, this is Cameron Mealy, and today we're going to share some economic data for the last month and also how our portfolios performed, and then also discuss what we see coming for the next month or so and our expectations for our client portfolios. Cam, why don't you kick us off with some economic data?
Thank you. Morning, everybody. Hope everybody's well out there. Really two big pieces of economic news that were been talked about last week. Number one would be second quarter GDP. Number two would be Federal Reserve. So let's talk first about second quarter GDP. Last week on July 28th, the Bureau of Economic Analysis released their advance rate, which is their first reading on second quarter GDP. That advance rate showed a decline of 0.9% on an annualized basis. That follows a 1.6% decline in the first quarter against an estimate from Dow Jones of a 0.3% increase. So obviously, Kelly, in spite of what the White House and the administration might say, the kind of classical definition of a recession is when you have two negative quarters of GDP. First quarter is negative, second quarter appears to be negative. It looks like by those measures we are in a recession. I think if you kind of look around between inflation, between the rise in interest rates, between kind of some general malaise, consumer sentiment, it sure feels like we're in the midst of an economic slowdown that probably takes this economy into a recession. And, I don't know when we start moving positive again.
So, a couple things unpacked there. In the simplest terms, like Cam said, and that's kind of always been the classic definitions, two negative quarters in a row, you're in a recession. There's other definitions of recession that start to take into account unemployment, which has been very strong.
Remains very low.
Business activity, business inventories, productivity. Those measures are all good, but then again, we have negative growth, so there's a lot of debate out there. Are we really in a recession now, or the real recession hasn't happened? Can we come out of it, or can we avoid it? And so that's where a lot of debates happening.
Yeah. One of the interesting things that I'm seeing is when I've talked to a lot of our clients who are business owners, they're actually starting to see a pickup in hiring. So it's as if all of this pent up wealth and savings from COVID, from government assistance, has kind of gone through the system, and now people are like, geez, I have to get back to work. Especially on the hourly labor side. So
money's running out.
Money is running out, and people are back to working. So, we can debate if we're in a recession or not. I'm going to have some comments by the conference board. They're certainly seeing a slowdown. But really, the other big piece is obviously second quarter negative GDP. Last week, we also had a 75 basis point increase by the Fed. Their second 75 basis point increase, one in June, one in July. They've now increased their target rate by 225 basis points this year. And there are most economists that think that another 100 basis points is coming before year end.
So with that last increase, that takes the Fed funds rate to between 2.25% and 2.5%. And the assumption is, at least from our standpoint, that the Fed will continue to raise interest rates. Some of the news yesterday, or from the comments that Powell made, some of the members on the Federal Reserve Board believe 2.5% is the neutral Fed funds rate. Mm-hmm. But then again, if we're trying to stave off inflation,
you got to be higher.
You have to go higher than neutral. And I think we talked about this last month. Based on the amount that Volcker had to raise rates back in the 80s, using the ratios as to how much rates had to rise, my calculations come up with really being equivalent to what we did in the 80s. That would mean a Fed funds rate in the low fours, maybe 4.25-ish. Mm-hmm. So I believe that the Fed's going to keep on going. Some of the market, or a lot of the bond market, or a lot of participants in the market think that, okay, if we're going into recession, the Fed's going to reverse course and bring interest rates down. And what we've seen is short-term rates have gotten higher than longer-term rates. It's inverted yield curve now. And this time it's kind of the real deal, where the 10-year Treasury several weeks ago was at 3.4%. Now it's down to 2.7%, which has helped the bond market and has helped bond funds. But now we're at a point where another 50 basis point or a 0.5% increase in interest rates would make the 10-year the same as Fed funds rates. So a lot happening in the interest rate environment. Once again, the whole objective is to reduce inflation.
Well, and from a credibility standpoint, even if we do go into a recession, it's a marked recession, I can't see the Fed immediately reversing course and starting to cut rates.
I don't think they will.
Yeah, I mean, I think we're going to be in a higher interest rate environment for at least the next several years. To your point, a Fed funds rate around 4%, it is still very reasonable even on historic measures. And if neutral is 2.5%, you got to be above neutral to stamp out inflation. So, these higher rates are here. We're seeing with variable debt right now, borrowings are coming down. People are trying to lock in. So it's having its intended purposes. This will pull money out of the U.S. economy. So speaking about Fed Chairman Powell, if we're in a recession or not, we don't know. But this is comments from Chairman Powell last week. I do not think the U.S. is currently in a recession, and the reason is there are too many areas of the economy that are performing too well. Powell said at a press conference following the Fed's decision to raise rates by 75 percentage points for the second consecutive time. This is a very strong labor market. It doesn't make sense the economy would be in recession with this kind of thing happening. So, to your same point, there's still there's still 11 million unfilled jobs out there. There's a lot of people looking for work. Manufacturing activity has remained robust, but there's just a general feeling. I feel when I see people, when I talk to people, that there's angst there and there is a slowdown happening.
Absolutely. We are in a major transition from and we've said this before, a extremely low interest rate or no interest rate environment to a environment with higher interest rates. And to answer the earlier question as to when can the market truly start advancing, I mean, we had a great month last month, but once again, to me, it really feels like kind of a bear market bounce, because you really cannot have a positive market when real interest rates, which means the interest rate minus inflation, is negative.
Yeah.
You need to be at least at zero or positive, which means inflation has to come down, rates have to come up. Once again, we talked about this last month, and that's a dynamic we need to see before we can be comfortable. We're truly back in a bull market. So that's kind of the situation we're living in, and we can't predict the future. But the key is making sure we can, be prepared for it. And maybe the Fed does reverse course, rates go back down, everything's great. Okay, that's fine. It's not going to hurt our portfolios. We're going to make money. But the key right now is to, be invested, stay in productive companies so that we can get through this and know that we can survive in a higher interest rate environment if that's truly what we're going to. So that's kind of the setup.
I think our expectation is there's going to be volatility.
Absolutely.
We're not looking at much growth this year, probably even into next year. We're probably not looking truly to getting back to the good old times probably until 2024.
We'll be, I believe by, next year we'll definitely, well, I wouldn't say definitely, but pretty high probability that, we will have seen the lows by some point next year, if not before the end of this year.
Okay, so let me, one last point. This is from the conference board. This is a discussion about the U.S. economy, and this kind of dovetails in what we're talking about. They're certainly seeing a slowdown. The U.S. leading economic index declined for the fourth consecutive month, suggesting economic growth is likely to slow further in the near term as recession risks grow, said Ataman Olazundam, excuse me for that pronunciation, Senior Director of Economic Research at the Conference Board. Consumer pessimism about future business conditions, moderating labor market conditions, falling stock prices, and weaker manufacturing new orders drove the LEI, the leading economic index, decline in June. The consistent economic index, which rose in June, suggests the economy grew through the second quarter. However, the forward-looking LEI points to U.S. economic downturn ahead. And amid high inflation and rapidly tightening monetary policy, the Conference Board expects economic growth will continue to cool throughout 2022. A U.S. recession around the end of the year and early next is now likely. Accordingly, we've downgraded our forecast of 2022 annual real GDP growth to 1.7% year over year from 2.3%, while 2023 growth was downgraded to 0.5% year over year from 1.8%. So we live in, in an economy where kind of the historical norm GDP growth is about 2%. These numbers, obviously, what the conference board believes is we're going to come under that. So recession, probably very likely. If not recession, we're in a slower growth phase for
Absolutely.
sure as we work ourselves through this.
And at different areas, you're going to feel it more than others. That's the reality. So it's not going to be the end of the world. And the others, what also is going on, we're always talking about U.S. numbers, but globally, we're definitely the cleanest shirt in a dirty laundry. Things are a lot worse.
Yes, they are.
Europe's facing a more severe situation, especially with the war going on over there. China, I saw on TV this morning, they're still wearing masks over there. China's definitely not out of the COVID, out of their COVID slump. China's starting to have some major real estate issues over there.
Yeah. So, and they've got a debt issue.
They have
especially on the real estate side.
Yeah, major debt issues over there. So, we've always been pretty much U.S.-centric. I think we're in the right spots, and that U.S. focus will be with us for a while. That's for sure.
Yep, definitely.
Let's talk about the portfolios a little bit. Like I said, July was a great month, so good news there. Definitely some reprieve. The Dow Jones in July up 5.96%. The S&P for July up 8.25%. NASDAQ, good rebound there, 10.89%. The Russell 2000, which is small cap stocks, up 9.72%. Internationally, here you can see some of the numbers. International developed world, the EAFE, only up 3.47%. Emerging markets still negative, down 1.37%. Part of that because of the strong dollar. But then again, it's also a flight to safety. Things are getting rocky, so emerging markets definitely a higher risk area.
Yep.
Year to date, Dow's still down 9.61%, so no longer double digits. S&P still down 13.34%. NASDAQ still in bear market, so down 20.8%. Russell 2000 came out of bear market, down 16%. Internationally, once again, developed world down 17, emerging markets down 19. Our portfolios, growth with income fund portfolio, for the month was up 6%. Year to date, we're down about 6.75. Some of the stocks that hurt us earlier in the year had some nice gains. Nucor up 30% for the month. NVIDIA, big holding buyers up 20%. Microchip Technologies up 18.6%. Apple up 18.9%. Disney up 12.4%. Commodities, which have helped us, for most of the year, had a pretty tough June. Last month up 8.6%. So a little bit of rebound in commodity prices. The laggers last month, Verizon down 7.8%. Gold, even though commodities were up 8.6%, gold was actually down 2.6%. J&J down 1.7%, kind of a small bump there. Year to date, our biggest gainers, Exxon up 62%, Nucor up 20%, and once again, our commodity exposure, PIMCO Commodity Fund up 22%. Still our laggers for the year, NVIDIA down 34%, Nike down 30.7%, Disney still hurting down 31%, Lennar down 26%, Cisco Systems down 26%. Dividend yield portfolio for the month, 4.9% to the plus side, a little more conservative portfolio. Year to date, only down 4%, pretty solid there. Big gainers there, Eaton up 17.8%, Paychex up 12.7%, Blackstone, a longtime big winner for us, up 12%, Caterpillar up 11.6%, 3M up 10%. Once again, laggards, Verizon, British American Tobacco down 7%, Verizon down 7.8%, British American Tobacco down 7%. Year to date, winners in our portfolio, Merck up 18%, Edison 18.5%, Southern Company up 14%. See a little pattern there.
A little utility pattern, yeah.
Coca-Cola up 10%, British American Tobacco up 8%. Laggards year to date, Intel down 28%, Cisco down 26%, Blackstone down 19%. In our price potential portfolio, good July, up 6.8%. Year to date, down 6.9%. Once again, relative to the indexes, doing really well. Big gainers, Fiserv in July up 18.8%. Fox Factory, which we only bought on July 5th, up 17.5%. Analog Devices, 17.7%. Danaher up 15%. S&P Group up 12%. Big laggers, Comcast down 3.75%. Lithia Motors, which has been a good hold for us, down 3.5%. So not too bad on the downside this month. Year to date of stocks that we still have in the portfolio. So we have a lot of turnover in there, but still in there in the portfolio from the beginning of the year. Humana up 4.3, Fiserv up 1.8. Big draggers on the portfolio that we're still sitting on: Meta or Facebook down 52%. Intercontinental Exchange down 25%. Stryker, for a medical company, down 19%. Google down 19%. Microsoft down 16%. So, we have some laggards in there, but with the turnover and the trading strategy, we've still been able to, do pretty well for the year. In our small cap, this is where the fireworks are. For July, up 10.75%. Year to date, we're down 15%. Once again, versus the NASDAQ down 20% and the Russell down 16%, doing pretty well there. Big gainers in July: Clearfield, which is broadband fiber, up 59%. Ryerson, which is kind of a steel servicing company, or steel dealer, a metals dealer, up 28%. PAM Transportation up 30.6%. Martin Transportation up 28%. Haynes International up 18%. Some pretty good winners there. We'd have some losers. Ramaco down 10.7%. Synalloy down 1.8%. So not too bad on the downside. Big winners for the year: Lantheus Holdings up 165%. Clearfield up 16%. Northeast Bank about 11.5%. And laggards, year to date, that we're still holding: CyberOptics down 12%. And that's basically where we're at. So we've held in there pretty strong. We're not changing our approach. Once again, it's all about keeping things fairly simple. Buy quality companies, good solid fundamentals that will ultimately work in any environment. Companies that can handle higher interest rates. And on the bond side, stay short, which we've been doing. And we're going to hang on to our commodity exposure for a while. So that's where we're at.
As always, thank you very much for the trust you place in Ellsworth Advisors. We'll talk to you next month. If you have any questions about your portfolios, please feel free to give us a call. Thank you.
Thank you.